Peter Schiff is selling Bitcoin. In the first minutes of this little internet gem published roughly 10 years ago, in November 22nd, 2013, Peter Schiff discussed the Bitcoin versus gold debate. But since then, things have changed. His appearance has changed. His nuanced take on Bitcoin has changed as well. Now it's way more populist. But in the first few minutes of this video, it really sounds like Peter Schiff is selling new Bitcoin. Let's have a look together.
Hi everybody, this is Peter Schiff at Euro-Pacific Precious Metals, and I wanted to spend a few moments talking about Bitcoin. And while I have a lot of sympathy with what the Bitcoin community is trying to achieve, I just think they have the wrong vehicle. Now, I think the idea behind Bitcoins was to digitally replicate gold, kind of a gold standard for the internet, gold 2.0, as some people have alleged. And, if you look at Bitcoins, the way they come into existence is that they're mined, just like actual gold. You mine them into existence. And just like mining gold, when you mine for Bitcoins, you actually expend real resources, real energy. There is a cost associated with creating a Bitcoin, just like there is with gold. In contrast to central banks that create pretty much limitless amounts of currency for nothing, out of thin air at virtually no cost. And also, like gold, there is a limit. There is a scarcity in that there are only 21 million Bitcoins that can be mined into existence. I think right now there's maybe around 11 million. So there's still more that can be created, but again, it's going to cost money to do so. And also, like gold, Bitcoins are divisible. You can take one Bitcoin and make 100 million fractional Bitcoins that collectively would have the value of a whole coin. But the idea is that you can break your Bitcoin up into smaller increments for transactions, just like gold. You can have an ounce of gold, but then you can have a half ounce, you can have a tenth of an ounce, so you can make smaller quantities that are more ideal for transaction. But unlike gold, you can send your Bitcoin over the internet. You can't do that with gold. You can't transport gold because gold actually has substance. Bitcoins exist in cyberspace. When you have gold, you have to protect it. It could be stolen. You have to guard it. Maybe it costs money to store it. You have none of this. It doesn't cost you any money to store your Bitcoins in your digital wallet. So Bitcoins really replicate all of the properties of gold, even improving on some of them.
Doesn't it sound like a Bitcoin commercial? If you just cut this up properly, you could make really nice shorts out of this. It does show that Peter Schiff has had a pretty deep look at it even 10 years ago. And at that time, we were at roughly $600 per coin. Let's continue with the video.
Even improving on some of them. But here's the problem. They replicate all of the properties except the single most important one. See, without that property, gold never would have been money. I'm talking about value, intrinsic value of the metal itself. You see, Bitcoin doesn't have any. The reason gold became money was first it was valued as a commodity. It was a luxury good known throughout the world. Everybody wanted gold. And so that you knew that if you needed something, you can always buy it with gold, because even if the person who accepted your gold didn't want it, he knew somebody else who did. Now, gold was uniquely suited to be money over a lot of other commodities and basically won the free market competition for money because it had a lot of other characteristics. These are the characteristics that Bitcoin is replicating, but they are not replicating the intrinsic value that made gold desirable in the first place. The only reason that anybody wants Bitcoins is because they believe somebody else wants them. They want them to exchange them for the things that they want. People want gold for itself. Yes, it can also be used to exchange, but it has a value unique to itself. It has its own properties that are desirable. There's nothing you can do with a Bitcoin except give it to somebody else. Now, there are people that might say, well, that's intrinsic value. The fact that it's easier to use than gold gives it intrinsic value. No, it doesn't. Go back to the original currencies. The original currencies were issued by private banks. In fact, if you go back to the beginning, the first currency was issued by a goldsmith. Somebody took their gold to a goldsmith, and he gave him a warehouse receipt for that gold. Now, the person who owned a warehouse receipt from a reputable goldsmith, instead of going back to the goldsmith and fetching his gold, he might be able to take that receipt and exchange it with somebody else who had goods and services that he desired, and the other person might accept it because they recognize the receipt. They know it's a reputable mint. They know there's gold there. And so that warehouse receipt can circulate as currency. That's what banks did. Before the Federal Reserve in 1913, private banks all around the United States issued their own note currency. The currency was backed by gold that the banks had in their vaults. But it was easier to use the currency. Rather than lugging around gold, you can use these banknotes. So the original paper currencies had a benefit that gold didn't have in that it was easier to use than the gold itself, but that didn't give paper money backed by gold intrinsic value. The only reason the paper had value was because it was backed by the intrinsic value of the gold. If there was no gold behind the paper, nobody would take it. Now today, of course, we don't have legitimate currency. We have fiat currency. There is nothing behind the dollar, which is why people think, well, then what's wrong with Bitcoin? Because there's nothing behind the dollar, and so there's nothing behind Bitcoins, therefore, it's the same. Well, there is a significant difference. See, the dollar is legal tender here in America. Other currencies are legal tender someplace else. And even though I don't want dollars, the government only accepts dollars in payment of taxes. And therefore, if I don't want to go to jail, and I value not going to jail, that does have a value. The only way I stay out of jail is to have enough dollars to pay my taxes. So there is a legitimate use for dollars, even though they don't have any intrinsic value the way gold does. But Bitcoins don't have any intrinsic value whatsoever. So here's the problem. People are advocating the use of Bitcoins as if it's a form of money. But it can't be, because Bitcoins do not represent a store of value. You don't know what Bitcoins are going to be worth next week, next year, in 5 years, or 10 years. Nobody knows. Will Bitcoins be worth zero? They might, because they don't have any intrinsic value. Somebody could come up with an alternative digital currency that maybe is more attractive than Bitcoins, and people will use that one. Somebody might come up with a legitimate digital currency that's actually backed by gold. That's not hard to do. So there are all sorts of things that might happen. In the meantime, you've got a very volatile Bitcoin that, it swings in price. Most of the Bitcoins that have been mined are not circulating. They're being hoarded by the miners or people who bought some of the Bitcoins when they were just pennies a piece or a few dollars a piece. So most of the coins are being hoarded. They're not being used in commerce. They're not being sold. That's one of the reasons that the price is rising, because you have a lot of people trying to enter the market. They've been enticed into the market by the spectacular gain in price and a lot of media attention that has accompanied that gain in price. So you have new people coming into the market. But again, why are people buying Bitcoins? They're buying them because they believe the price is going to go up. They don't want Bitcoins for the Bitcoin because you can't do anything with a Bitcoin. They're hoping to spend the Bitcoins on something else in the future. That's the problem. You see, eventually, all the people buying Bitcoins are going to want to cash in. They're actually going to want to buy stuff. And that's when you have a problem. Right? That's when the bottom drops out of the market. That's when, it's not the gold standard 2.0, it's Tulip Mania 2.0. You're going to have a collapse in price in Bitcoins.
Now let's talk about this intrinsic value argument, because when we really unpack this, I think there is a big flaw here. What does something give intrinsic value, and where does gold potentially have more intrinsic value than Bitcoin or fiat? The way I understand intrinsic value is that the thing that you're buying has use by itself without having to exchange it to something else. And so when we go back 1,000 or 2,000 years, then of course we do have intrinsic value money, maybe by exchanging corn, right? If everybody has similar kind of quality corn, then you can make your own bread with it, but you could also exchange it maybe to a chicken. Corn then degraded, then came the metals. Metals also became not that user-friendly. And so we got these receipts on gold finally. But how much use is there really for gold in itself? Nowadays it is used in some electronics, but it's mainly used for storing value. In other words, there is a huge monetary premium on gold. If gold isn't used for storing value, then how high would the price really be? It would probably go down by 80–90%. The industrial usage of gold isn't high at all. There is some, but it's not high. The price is very, very inflated for gold because of its use as a store of value. And as Peter Schiff said at the beginning of the video, Bitcoin tries to improve upon some of the properties of gold. For example, a lower inflation than gold, for example, an easier divisibility and an easier way to transport it, to send it. And then comes the other argument, the US dollar doesn't have any intrinsic value either. But here Peter Schiff says that it has legitimate use, as in you can use it to pay your taxes and it's legal tender. It has to be accepted everywhere. Now I argue that paying taxes is probably one of the least important functions of the US dollar. Because how often do you use US dollars really to pay taxes? You use the US dollar in order to pay goods with it. It's not like you get the US dollar from your income, you instantly move it into gold, and once tax season comes, then you convert your gold back into US dollars. That's not how it works. People hold the US dollar because you can pay with it and because it gives the illusion that there is very little volatility in your purchasing power. It's very likely that the price of the bread that you're buying today is the same 1 week from now compared to today. We all know that 1 year, 2 years and 3 years is probably likely going to be more expensive, but at least in the short term, prices seem to be stable measured in US dollars. Everything is denominated in US dollars. And this gives some feeling of safety in holding dollars. That's why people are also afraid of buying stocks, for example, right? Stocks can also go down 50, 60, 70%, as can Bitcoin. And you don't want to necessarily take that hit in purchasing power, even if it is temporarily, even if you could wait it out for 10, 20 years. Some people don't want to wait that long to get back access to their purchasing power again. And so the real value in the US dollar is in its payment network and in its perceived little risk, at least in the short term. And so in that matter, all three forms of money that we are discussing here, right, gold, fiat and Bitcoin, they all don't have intrinsic value for the purchaser. They're all just used either to store value or to use it in a payment network to exchange it with others. What are you really going to do with the gold once you hold it? You're not going to eat it. You want to sell it later as well. You want to use that purchasing power that's stored in that overinflated monetary premium gold as well. And so Bitcoin is just the purest form of gold. It completely focuses on storing value and on transferring value. Or in other words, it's 100% monetary premium. It's not 90 or 95% monetary premium as we see in gold. It is 100% just used for storing value and for transferring value. The value of Bitcoin is in its payment network, but I argue it's even more in its properties to be used as a store of value, similar to gold. So the goods you're buying, they also fluctuate denominated in gold. The goods are not priced in gold, they are priced in US dollars. So you've got that volatility component on both gold and Bitcoin. And what you're doing by converting fiat into gold or into Bitcoin is you give up some of that stable price advantage short term to keep purchasing power long term over the many, many years. And since the inflation is lower of Bitcoin than of gold, it preserves purchasing power better. So this is all just a straw man argument. You can't do anything with your Bitcoin. You can't do anything with your US dollars either. You can't do anything with your gold either, except exchanging it for something else. At least that's the main use case. The industrial applications of gold are minute compared to its value. The usability of paying taxes with fiat isn't that great either, because then you could just hold it during tax season, but that's not what's going on. Let's continue with the video.
That's when, it's not the gold standard 2.0, it's tulip mania 2.0. You're going to have a collapse in price in Bitcoins. I don't know where the top is, right? Is it the top now? I don't know. It might be. It might not be. We know it's not the bottom. Clearly, if you're buying Bitcoins today, you're not getting it at the bottom. You may be getting it at the top. Maybe not. Maybe somebody else is going to get it at the top. But at some point, the psychology is going to turn and the price is going to drop. In the meantime, there's so much volatility that you can't actually use Bitcoins as money. They're not even desirable for the feature where they're being marketed as a method of commerce, because you can't use it because the price is too volatile. Now I know that the Bitcoin promoters are saying, trust us, one day the volatility will go away, only the price will stabilize at some permanently high plateau, to borrow an old metaphor from Irving Fisher. But I think that's more wishful thinking, and I think a lot of the people who got into Bitcoins and who have thousands or of these coins or hundreds or whatever they have, they certainly have a vested interest in trying to expand the market to try to talk the market up. Now, maybe a lot of them truly believe it.
Now I want to talk about this volatility. We all know that Bitcoin is volatile and so is gold. And to a degree, this video has aged pretty well in regards to the volatility. Because what we can see in that chart here, this vertical line, this is when Peter Schiff published the video. And the price of Bitcoin, as he sometimes said in the video, the price of Bitcoin went down by 76% afterwards. This is a weekly chart, so even within the week, it's probably more than that. Let's go completely with the absolute top and go to the absolute bottom. We saw a drop in Bitcoin of 86%, and that was due to Mt. Gox collapsing, the major exchange, and Silk Road being shut down. Silk Road was a marketplace to buy and sell illegitimate goods. So yes, Bitcoin is volatile, but there's always the question, how do you measure volatility? Do you just take the standard deviation of prices? Do you take the drop from top to bottom? Do you measure how long does it take to reach a new all-time high after a crash? So instead of the extent of the crash, we look at the duration of a bear market. And what about volatility versus other assets? So let's say Bitcoin and gold both compete with stock money. So stocks being another form of volatile investments. Again, a long-term hold that can sometimes crash, but that hopefully over the decades appreciates. Why not measure Bitcoin and gold relative to the S&P 500? This here is the gold chart divided by the S&P 500 price. And again, the vertical line is when Peter Schiff published his video. Gold underperformed the S&P 500 in those 10 years by roughly 37%. Now let's zoom out a little because we are long-term investors. This arrow, by the way, is when the SPDR ETF had been approved. Let's zoom out further. This is a very, very long-term chart. So this starts in 1904, almost 120 years of data. So when this is high, gold is very expensive relative to the S&P 500. When this is low, then the S&P 500 outperformed gold. And so we're talking about volatility, right? Let's talk about volatility not in terms of what you buy from it, but volatility in an asset portfolio. From 1980 to the 2000s roughly, when there was a real technology boom, gold underperformed the S&P 500 by 97%. Gold, the super safe thing, underperformed the S&P 500 by 97%. This is how strong the psychology shifts in the markets are. We've also seen the exact opposite. Look at what happened after Bretton Woods. So let's just go back a bit further. This vertical line here is Bretton Woods. This is when the dollar could not be converted to gold anymore, so people bought gold directly. And so gold outperformed the S&P 500 by 1,260%. Again, within a relatively short span, less than 10 years. So how do you measure volatility? Do you really measure it in terms of what you can buy with it? Or do you measure it in terms of other financial instruments? Because really, when you save for retirement, you're not going to redeem all of your retirement money at once, right? You're redeeming it step by step, a little bit every month. And so what you should be concerned about rather is, what is the entirety of my investment portfolio like? How is the volatility of my overall investment portfolio moving? And for that, I'd argue that an over-allocation to gold as to Bitcoin is a big risk, because we do get these massive swings in both assets. You really want to be diversifying, and in this, gold and Bitcoin is very, very good because they both have very low correlation to the S&P 500. In other words, you reduce your overall portfolio volatility by buying all kinds of different things because they go up and down at different points in time. And so it might sound like I'm bashing Peter Schiff here to advocate for gold. Of course, he does have a vested interest here as well to push gold. In the end, he's selling it. But what I really want to say is that you want to have everything. You want to have property. You want to have some precious metal potentially. You want to have Bitcoin for sure because it's harder than gold. And of course, you want to have stocks as well. You want to own all of it because that's how you reduce your portfolio risk. And that's what really counts if you want to retire on that capital one day. You want to preserve purchasing power. Let's continue again with the video.
I think a lot of the people who got into Bitcoins and who have thousands or of these coins or hundreds or whatever they have, they certainly have a vested interest in trying to expand the market to try to talk the market up. Now, maybe a lot of them truly believe it. If you go back to the dot-com days, when there were a lot of internet stocks that were losing money but had billion-dollar market caps, a lot of the people that worked at those companies truly believed what they were saying. I mean, a lot of them went down with the ship. A lot of these internet millionaires lost their entire fortune because they never sold. So I'm not doubting the sincerity of a lot of the people who own Bitcoins. I just think that their judgment is being clouded by the money and by the potential of a windfall if what they're hoping to occur does. But it's not going to happen because, again, what makes gold money is not just the fact that it can be divisible or that it's scarce, but that it has intrinsic value on its own. Without that, none of the other properties matter. So even if Bitcoin can replicate every property of gold except that one, then it doesn't matter. And right now, sure, the price is going up and people are validating their belief in Bitcoin by the rising price. That doesn't validate anything. It just as easily validates my premise that there's a bubble in Bitcoins as if there's legitimate value there. Sure, people want to get in on it. They want the action. The price is going up, so they're buying. But when the tide turns, right, look out below. A lot of people are going to want to get out of their Bitcoins. There's not going to be that many people to buy, take the other side of the trade. And then when the price plunges, you're going to have a lot of people that are going to be very upset because they paid a high price for their Bitcoins and they're going to watch the money that they put into Bitcoins evaporate. In the meantime, if you're really looking for a true store of value, right, if you don't want to be in government fiat money, if you want to be in real money that can't be created at will, that can't be inflated away, buy gold. In fact, if anything, I think the recent weakness in gold has added fuel to the Bitcoin fire because some of the people who might be buying gold but maybe are discouraged from the recent price declines and they compare that to the skyrocketing price of Bitcoins, they jump to the wrong conclusions. The price of Bitcoins are going up, therefore they must be better than gold. I think it's going up because it's a mania, because it's a bubble. In the meantime, real value is being overlooked by people who are rightly concerned about all the money that's being printed, concerned about a currency crisis, and who want to do something about it, who want to preserve their savings. If they're choosing Bitcoins, they're making the wrong choice. Right? Bitcoins have been around for about 4 years. Gold's been around for more than 4,000. Will Bitcoins be around 4 years from now? I have no idea, but I'm confident gold will.
We've talked about the intrinsic value argument at length. Most of gold's price is due to its store of wealth, and all of Bitcoin's price is due to its store of wealth. And in case you're not aware, gold also inflates. Gold is being mined every day as well. The gold supply is increasing by 1 to 2% every year. Bitcoin supply is currently also increasing by 1.75% every year, but it is getting cut in half every 4 years. So in less than 2 years, we will be at less than 1% per annum, afterwards less than 0.5% per annum, and so on. We can also make a lot of blockchain analytics on Bitcoin. We can know how much Bitcoin had been lost. And when you look at that, you see that the rate at which Bitcoin gets lost is even faster than the rate at which it gets printed. Or to be more exact, it gets mined. So in other words, the liquid supply of Bitcoin is even shrinking. So yeah, there is something to be said that gold has been around for longer than Bitcoin. And in that regard, one might see this as the safer of the two assets. But in the end, money is just a technology, removed from stone rings to shells, to metals, to metal coins, to fiat, to Bitcoin. We are simply just searching for what's the best technology to serve our purposes. And for trading every day, this might still be fiat. It won't be gold. Who knows if it ever will be Bitcoin. But for storing value, we now have a real competitor to the S&P 500 and to gold, and that is Bitcoin. If you enjoyed this, please give this a like. And feel free to subscribe as well. There's also a Telegram group. Feel free to join us. Bitcoin Strategy Channel. Simply search for that within the Telegram app or click the link down below. I hang around there regularly. Looking forward to chatting with you. Bye-bye.